Welcome aboard the Bitcoin Express. My name is Chase. Let's get to it. In this video, we're going to go over what moving averages are and how traders use them towards their advantage so that they increase their probability of making a profit. A moving average is the average price of an asset over a certain amount of time. In the case of Bitcoin, it's common to use moving day averages of 20 days, 50 days. All this means is that you're taking the price over, let's say, a 20-day period, and you're averaging it out. And it makes it much more visually pleasing to the eye and easier for people or traders to look at and make a decision based off of it. If we're looking at the chart of Bitcoin, we can see there are many red candlesticks, green candlesticks up and down. But by just taking a 20-day moving average, we can see it looks a lot more visually pleasing, and we get a better idea of how Bitcoin is traded. This doesn't just have to be Bitcoin. You can do this with any asset. You can create a moving average for any asset. So this is a 20-day moving average. We can even do a 50-day moving average and see what has been the average price of this asset over 50 days. And when it comes to moving averages, you can do as many days as you want. You can have a 10-day moving average, 20-day moving average, 50, 100, 200. And how is it calculated? Pretty simple. You take the amount of days that you are getting the average for this asset. Let's say it's Bitcoin, 10-day moving average. You add the price up of Bitcoin over those 10 days and divide it by 10. It's that simple. Just like you would get the average age of 5 people, you take 7 plus 8 plus 7 plus 11 plus 13 divided by 5, you get 9. Very simple. This is how you get the moving average. So now that you understand what the moving average is, how does it help us? How does this benefit a trader? Well, there's ways to look at it, and off of that, you can make an assumption or a guess of how an asset will trade in the future. When the price of an asset is trading above the moving average, this is considered a support line. So this is a buying opportunity. There's support and it's on an uptrend. So we're gonna buy at this price, and the assumption, again, it's just an assumption, nothing is guaranteed, is that as the price of an asset drops, it will bounce off of the support line and then continue to go up. And then the opposite is when the price of an asset is trading below the moving average, this is considered resistance. So in this case, again, the assumption is the price of this asset will continue to trade, and whenever it reaches this resistance level, it's going to bounce off and come right back down. And if you're looking at this chart in front of me, you'll see right over here it says it was a fake out. The downtrend continues. What happened in this case is that people trading based off of this moving average, again, they assumed that there was a resistant level. And once it hits that resistance level, it's going to go back down. But in this case, the price of the asset actually went above the resistance line. So it was what they thought a breakout. Now there is going to be support, and now it's a buying opportunity. But then, of course, as you can see in this chart, the price went right back down below the moving average. And why do I point this out? I point this out is because support levels and resistance levels, they are not a rule. They are not guaranteed. Again, it's just an assumption. It's a probability. And the shorter the time frame, the more you will see resistance and support levels change. If you're working with a 10-day moving average or a 20-day moving average, you're going to see the support and resistance levels change pretty often. In this chart over here, let's say someone was guessing or they were assuming, I'm going to base my trades off of support and resistance levels. So if they're following this chart here, they see there's a lot of support for this asset on the chart. And as they're looking at the chart, they see right here at the top that there still is support. So in their mind, they say there is support. That means if I buy this asset, it will continue to go up. And then when it drops down, it'll hit the support level and then go back up. But as you can see, if someone were to buy at this top over here based off of this assumption, next thing you know, they would have been part of the downtrend, the resistance levels, and they would have lost a lot of money. So typically we'll see a lot more movement up and down, support and resistance in shorter time periods. So if we take a 20-day moving average, let's say of Bitcoin, you can see that at this point that I'm hovering over, we have support. Over here is resistance. Still we're at resistance. Now we're at support. We can see that it changes often. But if we take a longer time frame, we get a smoother line. This is the 100-day moving average. Over here, we can see that we've been working with support for most of the time. So typically, moving averages are preferred by long-term traders because in the short term, again, it's just an assumption. Nothing is guaranteed. Even in the long term, it's an assumption. But there is more of a probability that the long-term charts will help you, because when it comes to technical analysis, it's not a guarantee. It's all a probability, and probability is based off of history. The longer the history, the more likely it is that someone will have a better idea of how the future will play out. Again, just a better idea because it's not guaranteed. So now that you know about support levels and resistance levels, let's talk about the golden cross. This is something that you might have heard about before, the golden cross. This is where a shorter term moving average crosses above a longer term moving average. So in this case, if the 50-day moving average, the shorter term moving average, crosses above the 100-day moving average, the longer moving average, this is considered a golden cross. This is a buying opportunity. And if the opposite is true, if the 50-day moving average, the short-term moving average, crosses below the 100-day moving average, this is seen as a death cross. So this is a selling opportunity. So a golden cross is a buying opportunity, and a death cross is a selling opportunity. So let's take a look at Bitcoin. Typically, when they look for these crosses, they'll use a 50-day moving average versus a 200-day moving average. So with Bitcoin, we see the 50-day moving average right here in blue, and then the 200-day moving average right here in green. So as we scroll through its history, we can see over here on about May 20th, the short-term 50-day moving average crossed above the 200-day moving average. So this would be a golden cross. Right over here, a golden cross. This is seen as a buying opportunity. And not long before that, we saw a death cross. Right over here, the short-term 50-day moving average went below the 200-day or longer trading average, longer moving average. So this would be a death cross. So this would be a selling opportunity. So we went over support levels, resistance levels, golden cross, death cross, and what it means. Does it mean we should buy? Does it mean we should sell? But I have to state this again. This is the most important part. When it comes to technical analysis, it is not a rule. It is not guaranteed. All it is probability. And like with other assets, things that have been around for 20 years, 30 years, we have a lot of history to look at. So it increases our chances at making the right guess. But when it comes to something like Bitcoin, it's only about 10 years old. That's not a lot of history to make a probability off of. And to make that even worse, although Bitcoin is about 10 years old, it hasn't really been trading on many exchanges for that long. Maybe 5 years, 4 years, where there has been heavy trading. And then on top of that, we have altcoins. Altcoins, some of them are only 2 years old. So taking technical analysis from only 2 years of history might not be the best idea. But when it comes to altcoins, they do tend to follow the movement of Bitcoin. So by looking at the movement or the technical analysis of Bitcoin, maybe one can take the same approach towards the altcoins that they're using. And I do want to end this off saying that although I'm saying that these are not guarantees, they're not rules, they're just probabilities, it still increases your probability of making a right trade as opposed to using no technical analysis at all. But this is only one of many different technical analysis methods. This is one of the basics, one of the simple ones. And as you can see, just with this basic simple method, if we take a 10-day moving average, 20-day, 30-day, 100-day, 500-day moving average, we're always going to get different results. So a lot of people, or I would say professional traders, they don't just use one indicator. They use many indicators. They compare them to each other. And even they know that with 20 years of trading experience with technical analysis. No one is guaranteed to make a profit, but they are able to increase their probability of making a profit. I hope that you found value in this video, and if you did, I want you right now to go down below and subscribe to the channel. Thank you for listening, and I'll see you next time.